As you can see, I'm a clinical professor. That means I don't have to pay attention to my own research, but I do have to pay attention to other people's. So this relies on research by Mark Rubinstein, who, by the way, would love the fact that we're here in Knoxville looking at this picture, and Doug Breeden. Mark Rubinstein came up with a theory that kind of connected with, hey, what's the trade-off between consuming now and saving for later and then consuming then? And in particular, what kind of implications are there about bond yields? Doug Breeden expanded that work, and one of his students, who was also at Duke, was Campbell Harvey, who decided to look at this and say, hey, let me check the empirical work. And what he tried to do was see what kind of information can we get about future GDP growth by looking at the bond market. And he found it's got about 30% power in predicting, whereas the stock market only has 5%. Well, if we look at interest rates, we think about what are the risks with interest rates. And the good news is that there are two kinds of risk, and they're kind of offsetting. Long-term bonds have a lot of price risk. If interest rates go up, they lose a lot of money. But they're good with reinvestment risk. If interest rates go down, they lose a lot. They gain money. I'm getting all this backwards. Anyway, what I'm getting at is that there's this trade-off where short-term T-bills have a lot of reinvestment risk, but they have very little price risk. And long-term bonds have a lot of price risk and very little reinvestment risk. This all fits in with what's going on in the bond market, where we expect to be rewarded for our investments. What do we get rewarded for? Price risk or reinvestment risk? Well, normally the yield curve, as we call it, is just a map of time and bonds that have that length of maturity. So long-term bonds have high returns. Short-term bonds generally have low returns. And the reason is because the market in general just tends to care about price risk and not about reinvestment risk. But every once in a while, we get a yield curve that looks like this. Short-term bonds actually have a higher return than long-term bonds. And this is called an inverted yield curve. And what it means, I think, because I'm looking for risk, is that every once in a while, the people who care about reinvestment risk are more worried than the people who care about prices. Now, you can see in general, here we're looking at yields of 3-month T-bills and 5-year T-notes. They tend to move together. You know, during the 50s and 60s, 70s, people are generally worried about price risk because interest rates are going up and down. And then after that, interest rates came down, so they worry more about reinvestment risk. What we're doing here is we're looking at the difference between 3-month and 5-year. And that's the blue line. But what's the red line? It's changes in GDP. And you can see that it's a lot wilder, but they kind of keep moving together. What ends up happening, this is one of the things that Campbell Harvey found, is that the spread between 3 months and 5 years is a great predictor of recessions. Every time it inverts, in his study, it was followed by a recession, and every time there was a recession, it was preceded by an inversion. In other words, 100% predictability. When we look at this map here, you see the bluish areas are recessions. Well, Harvey's dissertation was in the mid-'80s, so we've had 3 recessions since then. So those are tests out of sample. And with all 3 of them, sure enough, we had that spread, the yield curve inverting, those are the red circles, followed by a recession 3 to 5 quarters later. So even out of sample, it worked. Now, if you look at the 1-3 periods back, it barely inverts. It's barely negative. When that happened, his prediction was, we're going to have a recession, but we'll have what he called a soft landing. And sure enough, it wasn't bad. Well, I was a student of his in 1995, and one day he comes into class and he said, the Wall Street Journal just called me. They said the yield curve is flat. That's down at the bottom. See where the difference between those two is very small? He said, they want to know if there's going to be a recession. His answer was, it hasn't inverted yet, so I'm not calling a recession, but I think it means that the economy is going to slow down. Sure enough, that's exactly what happened. Since then, there have been 2 more inversions of the yield curve. In one of them, I was a PhD student teaching an undergraduate class, and I came in and I said, I think there's going to be a recession. I'll talk about this later. And the other one was in 2006 when it inverted. It inverted for a long time, and I told everybody I know, there's a recession coming. By the way, it's going to be bad. The good news is, from one point of view, is I was right and sort of looked like a genius. The bad news is they all looked at me like I was Cassandra in the Iliad, you know, where I'm coming at them with bad news and none of them believe me because they think I'm some nut. But if we look at what's been happening in the last year and a half, you can see that the spread is kind of coming down, but it's still positive. Since this graph, it's come down another 0.1%. And I think what this probably means is that, you know, we know that the Federal Reserve is artificially keeping short-term rates low for a long time, and they're kind of relinquishing that control back to the market, and that spread between 3 month and 5 years is coming out. So I think what's happening here is that you know, it indicates that we may have some sort of slowdown in the future, but at least so far, I'm not going to tell people that I think there's a recession coming, maybe in a couple of years. Now, why is this happening? This is the slide that I passed over. So what Campbell Harvey says is, think about being a CFO at a major firm. And it's a growth firm, so every time you make money, you got to plow it back into the company. Now, things have been going great for a while, and suddenly you think, what if there's a recession? So you think, maybe what I better do is take some of my money and park it somewhere safe, like in the 5-year note. And you do that, and then if you're wrong, you can just take your money out and put it back in the firm. But if you're right, you have enough money to keep running. Whereas if you don't do it, if you plow all the money back into the firm, you end up getting, put it all into the firm, everything's tied up in inventory, and you don't have enough money to pay your bills. So the bottom line here is that if a lot of people do that, you have a self-fulfilling prophecy. 3-4 quarters ago, everyone put their money in Treasury bonds, and now that stopped the growth within their company. Looks like I'm out of time, so I'll stop now. Thank you.